Welcome to the award-winning Moneymakers podcast. I'm Jonathan Davis, the founder and host. For more than 6 years now, we've been providing comment and discussion about all the latest developments in the world of investment trusts, the stock market listed funds often called the City of London's best-kept secret. I'm grateful to JP Morgan Asset Management for their continued no-strings support, which enables us to keep the podcast free while preserving our truly important independent editorial principles. Please note that while our comments are well-researched and our opinions honestly held, we do not offer individual stock recommendations. This week on the podcast, it's that time again for a monthly chat with Andrew McHattie, the editor of the Investment Trusts newsletter, to go over some of the more interesting recent announcements from the investment trust sector. So, Andrew, let's start with something which has been rumbling in the background now for a while. We've had some announcements, and that's what the FCA has been doing, the Financial Conduct Authority. We have talked in the past about the issue, whether or not we think that the FCA really gets investment trusts or not. And there have been some reasons on things like cost disclosure to wonder whether that is the case. But they have stepped up to the plate more recently with a couple of things they've announced, something on cost disclosure and something also on activist investors and what they can do to make life difficult for investment trusts. So why don't we start there and tell us what they've been up to and what they've announced recently.
Well, thanks, Jonathan. I think it's a great place to start because regulation is so important. Of course, all investors need to have complete confidence in the market in which they're investing. And investment trusts, I think, have been feeling for quite some time that they've had the rough end of things with the regulator, who doesn't seem to appreciate, I think, the very special nature of investment trusts. And I think this lies at the heart of the problem, that investment trusts are a peculiarly British institution. Actually, they don't really exist in the same format across the rest of Europe, and only to a limited extent in the US, closed-end funds. And so I think it's quite easy to misunderstand exactly what role they play. And the FCA, it seems to me, has been extremely slow to appreciate the special factors involved in regulating investment trusts. Although perhaps now it is catching up. Because, as you rightly say, Jonathan, there is progress now, good progress actually, on the cost disclosure issue, which means that actually investment trusts can be considered on a level playing field with open-ended funds. There is this review of the listing rules, which was really triggered by SERE. And then there's a third thing as well, actually, that I don't think has had very much publicity. And that is that the FCA is also consulting on changes to the Alternative Investment Fund Manager rules, the AIFM rules. And this is relevant because some smaller fund managers, and this really occurs considerably with self-managed trusts, they may have to be governed by some separate rules. So this prevents some smaller funds from using gearing, for example. And I was thinking, Jonathan, that, gosh, this has been going on for quite a long time. And I remembered writing about this in my newsletter and moaning about the rules not being very good. And I checked back to see when that was. And it was actually in April 2014. So really a very long time ago. And I think that just shows the glacial pace at which the FCA moves. But finally, Jonathan, it is moving, and I think investment trusts will be better served once this period has passed.
Yes, well, let's just quickly talk on a couple of those. I suppose the most upfront ones are about the situation with SERE, where what they've proposed is a series of changes to the listing rules clearly designed to stop activist funds like SERE from taking over investment trusts, what people call through the back door, in other words, by using their 30% stake, which is the maximum they can do without actually launching a bid under takeover rules, and then putting pressure on the boards and forcing votes and essentially making changes even though the majority of shareholders have actually rejected them and what they're proposing. So of the things that they're proposing, what do you think is the most potent that they've said?
Well, I think that's extremely important, actually, the one you've outlined there about the listing rules, because, of course, we have seen SERE effectively take control with its proposed directors of two investment trusts, Edinburgh Worldwide and Impact Environmental Markets, even though, as you say, the majority of shareholders voted to continue with those trusts in the current format more than once. And so I think the FCA proposals there are very sensible. Now, those are in a consultation phase at the moment, and are likely to be implemented, I think, before the end of the year. So that's fairly imminent. And I think that's so important because I think SABR and potentially other similar organisations might otherwise just have continued to march through our investment trust sector, effectively removing trusts or changing them beyond recognition, even though shareholders had said they wanted to continue as they were.
Indeed, and that's been a reality for a while. And the fact that they've changed the rules obviously confirms that effectively SABR has not been breaking any rules as they currently exist. So they've been smart enough to spot the opportunity and to exploit it. But perhaps they've been too successful in the sense that they have actually now created this backlash. There has been lobbying by the AIC. You might question, I suppose, whether they could have done it earlier or not, been more forceful earlier on, easy with hindsight. But the other thing, of course, is to tackle this sort of anomaly where you've got a minority shareholder which is proposing directors who are allegedly independent with the stated ambition of becoming the manager of that trust. Now, so far, that hasn't happened in the case of Impax Environmental Markets and Edinburgh Worldwide. They're still managed by the existing management teams. And I guess you wonder whether or not these new boards of so-called independent directors, if they are independent, whether they will demonstrate that by actually not going ahead with what SABR wants. What do you think? It's going to be an interesting dilemma for them, isn't it?
Perhaps it will. Yes, it's very hard to know what's occurred behind the scenes here, isn't it? And the fact, I think, that SABR nominated these directors probably tells you that they're not very independent. But that is our assumption. And who knows, that may not be the case. So I'm a little surprised that the new directors did not immediately seek to appoint SABR as the managers and to change the mandate for these two trusts towards investing in other investment trusts. That may well happen. It may just be that these things take a few weeks to sort out with the paperwork and the applications and so on. So we will wait and see. I think many people will be watching those two trusts quite keenly.
Yes, I mean, there's two issues there. One is, should they appoint SABR? But secondly, is the actual strategy that SABR is proposing, which is to carry on doing more of what they've been doing, is that actually the kind of strategy that could be successful from here? I mean, that's another very interesting point that they will have to consider. I mean, I certainly was of the view that originally this would be too late to stop changes, as SABR wants, but I'm not so sure now. Maybe it will have a deterrent effect. Because perhaps if you are one of these new directors, most of whom incidentally are not based over here in the UK, you may not wish to become on the FCA's naughty step, if I can put it that way. Interesting to see. Let's press on then. The cost disclosure, what they've announced there, that is really effectively just confirming what we already knew they're proposing to do as of last year. But it does mean that that issue is finally going to be put to bed, I think, to the satisfaction of all, and including making sure that platforms actually do put in the relevant cost figures that they have so far not always chosen to do. All right, let's move on and talk about some more perhaps interesting things. Let's talk about Alternative Income REIT, ticker AIRE. This is a relatively small trust, but it is now involved in a bid situation. Perhaps you can update us on this one. It's been a bit of a back and forth, this one.
It has, and I think this is an interesting story. So yes, Alternative Income REIT, it's a small trust. It's only £56 million of market cap. And I think genuinely that probably is too small to exist in a sector that has, of course, been absolutely full of consolidation. I think the property sector has led the way there. So this one has been on the blocks for a while, and it has received bids in the past. Now, it has a large shareholder, Glenstone REIT, which owns about 24.5% of the shares, and they've expressed an interest in taking it over. And they've come to the party with a couple of quite low bids, actually, at 70 pence per share, and then at 71.4 pence per share, although arguably, because of the timing of dividends, that wasn't actually a proper increase. But that looked too low. And what has happened now, which makes it interesting, is that AEW UK REIT, which is another good investment trust, that one has come back with a second bid, which is a better one, I think. Now, at this stage, it's still a potential proposal. It hasn't been confirmed. But the outline terms, it's an all-share bid, 0.725 of an AEW UK REIT share per alternative income REIT share. And that would work out at about 76.5 pence per share, which is around a 6% discount to NAV. So I think a very decent offer. Now, against that background, when you look at the current market price of 70.5 pence, there's a bit of a gap there and it looks anomalous. And I think the explanation for that is that AEW UK REIT has been here before. It did back out of a possible offer in March of this year. And we never really knew why, because it seemed like that was going to be a done deal and made sense for all parties. So I found it really interesting in the detail here that they explained actually what happened last time. And it wasn't that they didn't want to proceed. It wasn't that the due diligence showed up something unpleasant. It was just that certain key information wasn't available to allow them to complete it within the time frame allowed. And also at that point, they had no access to Glenstone to speak to them to see what they thought. So they felt they couldn't proceed. But there's clearly a bit of market scepticism still remaining here. And AEW UK REIT does have until August the 28th to decide whether it is going to proceed with its bid. It seems very likely to me. And maybe there's a bit of an opportunity if you're a discount hunter and you're looking for small anomalies to pick up a few shares here.
And I guess this would have the impact of helpfully bulking up AEW UK a little bit. It's one of the few survivors in the sector, as we pointed out more than once. And it has one of the better records of the commercial property trusts operating in this kind of more niche areas. And they're currently market cap around 167 million, I think. So if they were able to bring an alternative income REIT, we don't know whether Glenstone would hang around or not. That would be, I guess, another issue. They have an existing stake, as you say, in alternative income REIT. But even if they were to disappear, it would still be a useful bulking up for AEW UK. So that one's all still in play. Let's talk also about another commercial property trust. This time, not such a good story. Schroder European Real Estate, ticker SERE. What's the news from here?
Well, you're right. There's so much going on in the real estate sector and it has shrunk so much. And here's another one. Schroder European Real Estate. This trust has announced that it's going to enter a managed wind down. Perhaps not a great surprise. Again, the market cap is not that large. It's £87 million. And of course, the main reason is that the trust is on a 33% discount. And it's struggled to close that, as have other trusts operating in the European real estate space. It hasn't been doing that well either. In the second quarter, it's just announced its NAV was down 3.9%. It had a disappointment there with a Paris office development. And it's going to wind down. Now, that's not going to be immediate because, of course, it's not as easy to sell a property portfolio as it is to liquidate an equity portfolio. So they've said it could take 2 to 3 years. The good news is that it doesn't have a huge diversified range of assets. It's got quite chunky assets here, 14 of them in total, in France, Germany and the Netherlands. So it's going to proceed to sell those and we'll see what value comes to pass. But I think this really marks the end of the small European real estate sector in relation to investment trusts. They're all disappearing. So Aberdeen European Logistics Income is winding down. That's almost finished, actually. It's got one more asset, and we may well have news about that next month. Phoenix Spree Deutschland has started to give capital back as well. So there's not going to be much left here for investors.
And I think it's fair to say the performance of this one has been disappointing. I mean, they've been on the market, I think, since 2015. I'm just looking at the numbers now, and the annualized percentage total return over that period is effectively just 1%, which is not really very good. And the share price has never really got back close to the issue price. Obviously, it's paid a yield in the meantime, but that's really just been compensated for by the decline in the value of the shares. So it has been a disappointment. And I suppose looking back, we might say, well, what is the point of having a European real estate trust in your portfolio? I mean, it adds a little bit of diversification, but it has not been particularly a fertile hunting ground. I think we can say that.
That's so true.
Okay, well, let's move on then. We talked about SABA, so I guess we should just pick up what's happening with Herald Investment Trust. This obviously is one of the trusts where SABA has been in guerrilla warfare mode almost since the beginning of its campaign in the UK. And we know that this one, they have not succeeded in getting the management contract, and they didn't actually make it clear whether they were going to do that or not. But what's happened now with Herald? We know there's been a tender offer. Tell us what the outcome of that was.
Well, this story has, I think, reached its final chapter in relation to SABA. So Herald had announced a tender offer for up to 66% of its shares, to include SABA, who had agreed to accept the tender offer, taking an in-specie option to take the underlying shares at a zero discount. So a good exit, I think, for SABA. They would have, I think, eventually have counted this as a success, although they did have to hold the Herald shares for a pretty long time and tie up their capital. So that's a different question. But anyway, the tender offer has now gone through. Just over 60% of the shares were tendered in total. And Herald says that if you exclude SABA and other parties who really were pursuing short-term trading strategies, and if you remove the index trackers, then only around 10% of the other shares were tendered. I think that's maybe subject to, again, to a little bit of debate. That it doesn't really matter. What matters is that the remaining trust is still a good size, because Herald was quite a large trust, and it still has assets of about £650 million, which is plenty. So it's now going to get back to business under the umbrella now of Aberdeen Asset Management. That's a change, but actually with the same management team. And my feeling is that for Herald here, this has been a better outcome than it was for Edinburgh Worldwide and Impax Environmental Markets. And that's really, I think, perhaps because the board took a different approach. They didn't immediately try to launch a tender offer when SABA first started to bother them. And I feel that by entering into some discussions with SABA, they ended up with a reasonable outcome here. So the trust can continue. So those investors who've been very happy with Herald actually for many, many years can carry on.
Yes, and I think that's, as it turns out, as you say, it turns out that there has been a mismatch in supply and demand for the shares, and they were trading at a discount for quite a long time. But it has turned out to be at least an acceptable outcome, I think, in the sense that obviously the management team will not be making so much money through management fees as in the past, but they have a viable vehicle from now on, I think. And Katie Potts will remain the lead manager of that particular trust, which she effectively created and has nurtured all through so many cycles, and has done a good job for many of the companies in which she's invested. I guess on the negative, you might say, well, there are a lot of UK smaller companies who are involved in the tech area in particular, who have been supported, and some of them will have lost that support effectively by virtue of the trust becoming smaller. But that's, if you like, a secondary issue. And I guess the only question now is, those shareholders who want to stay are still there. What's going to happen to the discount? I guess that's the issue in the short to medium term. It's now trading back around, I think, a 10% discount. And obviously, briefly, the discount came right in at the height of the drama involving SABA. But over history, it's always traded at a much wider discount, right? About 20%. So I guess there may be a short-term hit still to come there in terms of the discount. I don't know if you have any thoughts about that, or whether you think that the effect of all this, of getting rid of a lot of shareholders who were happy to leave, means that supply and demand is now more in balance than it was before.
I do feel you can make that case, actually. And I do think as well that there's a tendency for discounts to become anchored. And I think it just became normal for Herald to trade on a discount, often between 15 and 20%. That was just what was expected. And so if you were a potential buyer, you would wait for it to get out to that range before you'd think about buying. And now it's been through this considerable reset, and I think a real shift actually in the balance of supply and demand, so that anybody who was thinking of selling or was a reluctant holder has been able to exit. And I do feel that perhaps that 10% level is now defensible. It is going to be interesting to see whether that is the case, but that's my feeling at the moment.
Just one final thought on this. Again, I mentioned the 10-year total return of the Schroder European Real Estate Trust. The 10% annualized total return for Herald is been 15%, which of course is fantastic. But a part of that has been the fact that the discount is significantly narrower than it was 10 years ago. But that's contributed to that return. So I think what happens to the discount will be important in the level of future returns. But I think most people in the investment trust world would say that we're very pleased that Herald has survived this ordeal, if you like, and lives to fight another day, unlike the other two we've mentioned, or at least as far as we know so far. Let's move on and talk about another trust where there's been activity involving the manager and changes, and that is Golden Prospect Precious Metals. This is a trust that, as its name suggests, invests in companies that are producing precious metals. And the outcome here is perhaps not what everybody was expecting, I think. There's been obviously a review of the future of this trust after the previous managers said they were leaving. Tell us what's happened on this one.
An interesting one, this, I think. So in March, the two portfolio managers, Keith Watson and Robert Crayford, resigned from CQS and said they were going to move to Tufton Investment Management. And they were the managers of three trusts at CQS. So there was this one, Golden Prospect Precious Metals, and also the CQS Natural Resources Growth and Income Trust, and also Geiger Counter. And I think usually the presumption is that the boards will follow the managers who have been successful with these trusts. And so I think that's a reasonable default position to think that Tufton would just sweep up these three management contracts. But actually, that's not what has happened so far. Now, one has moved to Tufton. So CQS Natural Resources Income and Growth has moved to Tufton, or it is moving to Tufton in September. But Geiger Counter has, for the moment, switched to another management team at Manulife Canada, and the board there is still considering its long-term options. And that brings us on to Golden Prospect Precious Metals, which did surprise us, actually, last week when it said it was moving to Baker Steel instead in the third quarter. Now, Baker Steel are currently the managers of the Baker Steel Investment Trust, which has done very well, actually, over recent times. And it is used to managing smaller companies in the mining and commodities space. So Mark Burridge and Trevor Steele will take over this portfolio again in the third quarter. And that's part of a package of changes here. So it's not just the change of management company, it's also some lower fees. And it's always good to see the new managers making a contribution to the costs of the change as well. There's going to be a new 6% enhanced dividend policy, which I'm not a big fan of, but it does seem to be very popular with many other people, including a lot of investors. And also a possible move to the main market, which has some regulatory impact on this trust. It should be helpful for the trust for the future. So that's quite a package of news there. And I think actually what this shows is this subject that we do keep returning to, that boards are independent. They're not tied to the managers, whether that's a management company or in this case, the individual portfolio managers. And they are free to make what they consider to be the best choice for their shareholders. So bravo to the board. I hope they've made a good choice, but they've certainly demonstrated their independence.
They certainly have. Interesting to note that the shares of both trusts have sold off a little bit this week. Obviously, there are other factors involved, like what's happening to gold and other metal prices. But it would be interesting to see it. I mean, the only thing that surprised me was this adoption of a 6% enhanced dividend. It's quite an interesting development for a trust that invests in companies which are historically, at least, normally very volatile. And so it does seem quite interesting that they've chosen to go down that route. I mean, it is true that the gold price, where it is, for example, is still well above the cost of production for many, many trusts, so they are generating surplus cash flow. But that's obviously one reason why you want to own them. But it will be interesting to see, because I think this is certainly one of the more surprising companies that adopted this policy. I'll be interested to see how that goes. So in the meantime, if you're interested in those sectors, you have still got some choice, and you've got a choice of different managers as well now, if you look across the whole field. So that's an interesting development. You are listening to the Moneymakers podcast. To keep up with every single item of news from the investment trust sector and all the latest share price, NAV and discount movements, why not try a subscription to the Moneymakers Circle, our premium content newsletter? You'll find there our in-depth independent profiles of more than 200 investment trusts and more commentary. Go to money-makers.co for more details. do please like, subscribe, and share through whatever platform you're using. As well as the usual podcast channels, we can also be found on YouTube, TikTok, X, Blue Sky, and most recently on Substack. Visit the website for more details. Let's talk about another trust that we may not be seeing for much longer, and that is Brown Advisory US Smaller Companies, ticker BASC. The board there has announced a strategic review. This trust, I think, has a market cap of around 175 million, something like that. What do you think is going on there?
I do wonder whether this could be exactly the wrong moment in the cycle to be doing what it's doing, but let's outline it first and see what we think. So this is a US Smaller Companies Trust, total assets about £190 million, so a reasonable size, but it does have a very poor medium-term record. For quite a few years, when I've been writing my January summary in my newsletter, I've just dismissed this trust and also the JP Morgan one operating in the same sector because they've been so far behind the mainstream US investment trusts. Because, of course, over recent years, if you've wanted to extract strong performance from America, and there's been plenty of it, you've needed to be in the mega caps and the larger companies. So the smaller company sector has struggled. And over 5 years, I think this trust has made a total return in aggregate of about 15%. So that's really pretty poor. What makes it worse is that it has really lagged its benchmark. And it's not lagged it marginally, it's really lagged it significantly. Over 5 years, it's returned less than half of the benchmark return. And if we look over the last 12 months, for example, the absolute return from the trust has been okay. It's been up 24.5% in NAV terms. And you think, well, that's quite good. But the benchmark is up 45% over that same period to the end of June. So the trust has really been struggling with its strategy. And whilst it does already have a performance-related tender, which is sure to be triggered, I think, in the second half of 2028, it's not a great surprise that the board have said a number of shareholders have indicated a preference for a liquidity opportunity in the shorter term. And that's why they've instigated now a strategic review. And they have said, interestingly, that they're not looking for a takeover. They're perhaps looking to tweak the trust, provide a cash exit for those who want it. And I think one of those shareholders that want it could well be SERE, who have a 16% stake here. So perhaps something can be formulated here to allow SERE to get out and to allow other shareholders to get out. But I'm not convinced. The track record here is so poor that I'm not sure the trust is going to continue.
I should just say that this trust has been managed by Brown Advisory since 2021. It used to be a Jupiter-managed trust, and the long-serving manager there, a guy called Robert Siddles, retired, I think, and the board made that switch. But as you say, US smaller companies has been a very disappointing sector. I mean, there's only 2 trusts in it. You mentioned the other one is the JP Morgan Trust. They have had rather disappointing performance over the last 5 years. Over 10 years, slightly better record. Okay, that's that one. And then we can talk next about a subject very close to your heart, I know, which is the battery storage sector, where we've had some news from Gore Energy Storage, ticker GSF. Tell us about their latest results, which I think has come a bit of a shock to some people.
I do feel as if I've been writing about batteries for a long time, actually. And of course, these trusts keep pumping out lots of news. A lot of it is bad news. And sadly for shareholders in Gore Street Energy Storage, we've had more poor results here, more disappointment. So for the year to 31st of March, the net asset value total return was minus 23.9%, which took the NAV down to 74.9 pence. And this has been what's been happening for a while, actually. This has been the trend that whilst the discount has been extremely wide, that's being narrowed not by the share price rising, but by the assets falling. And in this case, the primary reason, the main culprit, was lower power price forecasts. So they've used new lower forecast curves, which does cut the NAV. Actual revenue was also lower. They've written down their Kremsau asset in Germany, which they're about to sell. So that's not very promising. They've also written down their Big Rock facility in California. They've included some project oversight costs, which perhaps should have been in there before. Maybe that was an oversight. So it was just generally a grim announcement with lots of bad news in there. And you could argue that maybe this is a clearing of the decks, because they want to focus on their strategy now of selling assets to support a 7p dividend payment. But I think many investors are comparing Gore Street now with Gresham House Energy Storage Fund, which is taking a very different approach, and they are sacrificing dividends in the short term to invest in growth and to try to reformulate the company and the business. And at the moment, the market is indicating that it much prefers the Gresham House approach, because Gore Street Energy Storage, even with this reduced NAV, is still on a discount of about 38%, whereas the Gresham House Trust is on a discount of about half that level. So the market is currently saying, we don't like your strategy very much, we don't believe in it. This bad news was a disappointment, but maybe it wasn't really that much of a surprise. So I think the pressure is really on Gore Street now to press on with those asset sales and to give the market something better to focus on.
They do pursue a different strategy, these two trusts. I think it's fair to say, if you compare Gresham House and Gore Street. And I do remember, was it that long ago when people were saying, well, the great advantage of Gore Street is that it's not just solely focused on the UK and it's internationally diversified. Well, it hasn't sort of worked out that way, has it? And they don't seem to have found the solution, or at least convinced the market that they are doing the right thing. So what would you think would happen here? So it's smaller, obviously it's a smaller trust than Gresham House Energy Storage. It's 230 million, I think, roughly, isn't it, market cap? Whereas Gresham House is significantly larger than that, even with still a significant discount. What do you think would happen, do you think? What's your best guess here?
Well, the board has set out its stall. It's been through a strategy review and it has come up with this strategy, this plan to find a way forward. So I think it's reasonable for shareholders to give them some time to implement that plan to see if it does work. So they've said they're going to try and sell assets to support the dividend and narrow the discount. So let's give them an opportunity to do that. And I don't know what time frame is reasonable, but certainly we're in the early stages of it now. So I think for the moment, they have enough support from their shareholders to proceed. But I suppose, Jonathan, if in a year or 18 months' time, that strategy doesn't look as if it's working and Gresham's House perhaps is, then at that point you may see Gresham House come in and take these assets away from Gore Street. But I think that's somewhere away. So for the moment, I think we are going to give this status quo an opportunity. Let's see these two different strategies at work and we'll see how they play out.
Obviously, the yield on this one is a significant factor. If you look at the AIC website, for example, it tells you that they're offering a 15% yield, which is obviously a very high number, the kind of number that normally suggests that the dividend may not survive. Did they say anything about that?
Well, for the moment, they're backing that 7p dividend. That's what they said, that's what they're intending to pay. And clearly, that's not going to be supported at the present time by underlying revenues. So it's an uncovered dividend. But as we have been talking about, actually, uncovered dividends are not that uncommon now and they can be paid. So at the moment, Gore Street is saying, well, if you allow us to execute our policy, we will move towards a covered dividend over time. And that 7p is what we're intending to support. So that's their position. Now, we know, of course, that often when a yield just looks too high, and maybe 15% is too high, then it lacks credibility, doesn't it? And often there is a reset. So the board is saying they'll support 7p, but we'll see. It wouldn't surprise me if they decided to reset it back down to, let's say, 5p. But for the moment, that's what it is.
Indeed, and just to complete the stories of woe that are still coming out of the renewable energy sector, let's just briefly catch up on the news from Next Energy Solar Fund, ticker NESF. It's another trust where people have raised questions about its future. What do we know as of this week?
This fund has been struggling with its debt levels and its discount level, and it's not a great surprise, actually, that it has now made an announcement that it is to enter a formal sale process. And I think this is partly because they've seen the successful sale, I say successful in the context of the market anyway, successful sale of Bluefield Solar Income Fund to Drax Group at an 11% discount to NAV. And I think shareholders in Next Energy Solar Fund would be delighted if they could achieve a similar exit. Now, at the present time, there are no offers on the table. There are no discussions taking place. So I think this is going to take a little while, actually, to go to any kind of finality. But the formal sale process is going to start. And it's starting, I think, an interesting time where the share price is really not looking too bright. And the discount here is 34%, which offers quite a lot of scope for uplift if a good buyer can be found. So there is potential here, I think, to see some value unlocked. There's no way you're going to get the full NAV, I don't think. But if you could achieve, let's say, a 15 to 20% discount, then that would still be a decent uplift. But I wouldn't rush into it. I think it's always tempting to look at the share price of 50 pence and look at the NAV of 76 and think, well, I need to get some of that and sit on that in my portfolio. But this process is going to take quite a while. I don't think anything is going to happen for a couple of months at least. But this could be a trust we'll come back to.
Well, I think what we can say now with some clarity, I remember we talked about this periodically over the last 2-3 years, is that the people who said that these wide discounts on renewable energy trusts were very attractive opportunities, it turns out that the market, of course, are quite right at sniffing out the fact that those NAVs were, and indeed still are, they're basically grossly overstating the value of these trusts in the marketplace. And whether that's because you're having mark-to-model valuations where so much depends on the inputs that you put in, the interest rate you plug in, the power price that you plug in. And I think on both those counts, the power prices and the interest rate projections, if you look back 2 or 3 years, we'll see that they were way too high, essentially. But of course, you can justify anything on the basis of this is what the future might hold. So I think we can safely say now that the market had rumbled this, and if you believe these NAVs, all the transactions we've seen, even the very best trusts, I think in terms of Bluefield Solar had one of the best portfolios, they have gone out at a discount of around, 10%, I think, something like that in their case. So you just can't believe these NAVs anymore, I'm afraid. And I think that's a challenge for the whole alternative asset sector, actually, is that if you look across the piece, where you've got valuations that are based on models rather than on some other basis, there's a finger in the air and you have to apply a discount for the uncertainty that's involved in those projections. I don't know if you'd agree with that, but I think it's one of the factors that explains why this sector has been so disappointing in the last 2-3 years.
I think there is more risk attached to any valuation that comes out of a black box. And there are so many assumptions that go into these calculations that I think you're right. You're always at a risk of those assumptions moving against you. Now, the only point I would make is that potentially these valuations could have moved the other way. Actually, that if power prices were rising and inflation was coming down and interest rates were coming down, then potentially these could have all understated the asset values. So it's unfortunate that they've been moving in the wrong direction. But nevertheless, you still have that degree of uncertainty, regardless of direction, don't you? So yes, I remember when I was studying economics many, many years ago, there was the GIGO model of valuations, which was the garbage in, garbage out model. And I'm constantly reminded actually of that it does depend on the assumptions you're making. And I think the experience we've had with these renewable energy trusts shows us that we need to be a little bit wary of those.
It's fair to say the environment has changed significantly from when they were launched in many cases. That's perfectly true, very reasonable to say that. But the inflationary expectations, interest rate expectations, and power price expectations have all disappointed because of genuine reasons as well as simply plugging the wrong number in. But I think from a marketing perspective, it'd be much better if you come up with a number and then you beat it rather than you come up with a number and then you consistently fail to meet it. That's not a good look for anybody. Finally, then, let's move on and talk about a slightly more encouraging story, I think, and that is what's happening at RIT Capital Partners. This is the investment trust that back in the day was started by Jacob Rothschild And indeed, he was the kind of lead manager, or at least overseer, for the first 3 decades of its life. Now, tell us what's been happening there. We know there's a new management in there, and they're looking to turn this round from a trust that used to trade on a very good rating to one that's been on a very wide discount more recently. So bring us up to date on that one, Andrew.
Well, those managers have had a struggle here because I think RIT Capital Partners, unfortunately, became known, I think, as a rather dull, slightly moribund trust that wasn't really living up to its past glories. But I really think that's changed. And actually, this is a trust I've recommended on that basis, that it was trading on a very wide discount because it was really unloved. But the new managers seem to have settled into their job quite well. They've really, I think, started to sort out exactly what RIT Capital is offering in the way of diversified portfolio, including private exposure, and offering a range of assets to investors that are not correlated. And I think actually they've settled in well and their performance has really been improving. And I've noticed that the commentary around the trust has really been becoming much, much more positive. Now, the caveat to that is that the trust has still been struggling with its discount. And that has averaged 26.1% over the last year, which is clearly too wide. And I think for that reason, the Trust has now announced a tender offer for about £300 million, and it's offering an exit, interestingly, at a 15% discount. So not a 2 or 3% discount, which is maybe what we're used to, but a 15% discount. So not that generous, I have to say. And this has been announced, and actually you'll need to react quite quickly if you do want to take the tender offer up, because I think the deadline is in the next few days. So I think this is really interesting, and I've been looking at it to decide actually whether you should take up this offer or not. Now, I generally think it depends. It always depends. It depends on what kind of investor you are. I think if you're an active investor, then there's a few pounds to be made from this. There is a small financial benefit to taking the tender because a 15% discount does compare favourably to the current discount in the market of 19.5%. And I think there's a chance that will head back out to just over 20% after this. So you could make a few pounds by taking up the discount and maybe buying back the shares. But I ran some numbers on this, did some calculations, and I think the margin's quite slim. I think you're probably only going to make about 3% on your money. So maybe not worth bothering with, particularly if you're a long-term investor. I think if you're a long-term investor, you can just ignore this, carry on holding your shares, and look forward to this broader improvement that I was talking about. I do think it's a good trust. I think there's a chance here of a possible dividend increase for 2027. And the current yield isn't much, it's only 1.8%. But I think this is broadly good news. I think it's part of the board wanting to be seen to be proactive as well. And this is the new environment in which we're finding ourselves, that it's just not acceptable any longer for a board to just sit on its hands when the discount is this wide. And I think RIT is becoming a good modern trust with good modern management, a modern board that is willing to interact with the market, and this tender offer is part of that.
I mean, this is still a significant size trust. Market cap is, I think, around 3.4 billion. So this is a very large liquid trust. And a 300 million tender offer, well, that's sort of 10% of the market cap. So I suppose it's big enough to make a difference. The discount has come in a little bit in response to this news, which I guess is encouraging, but that may just be a technical factor ahead of the tender coming into effect. I mean, RIT seems to me has had a couple of issues. The halo effect, if you like, of Jacob Rothschild, who's a very successful, very smart man, and he created this kind of halo effect around the Rothschild name and what he'd achieved, which contributed to the trust always trading either at a very narrow discount or at a premium for several years. And so it's been a big change. They've lost that kind of halo effect. He's obviously, unfortunately, died, though the Rothschild family remain significant shareholders. And the second factor is, of course, they've always made the case for investing in their company on the basis of having 3 different legs of the investment process, one of which has been private equity. And they historically have done very well out of private equity, having very good contacts and getting many of the better deals. But having a third of your assets in private equity has not been a good place to be in the last 3 or 4 years. We know that private equity has been struggling very much for all sorts of reasons. So there's been another impact of that, I think, on sentiment towards the shares. And it's taken time for the new management to come in and to put a stamp on what they're doing. So I think we've always said it's going to be a slow and steady recovery program, but the share price is moving up nicely. The discount has begun to come in. And if that continues, I think there's obviously, I would argue, quite a lot of value there. And I think a lot of investors out there have been looking at it with a view to it maybe regaining its reputation as being a trust that does well in up markets, but also does relatively well in down markets. And I think maybe that story needs to be re-established. So I think there's a lot to play for here. And it does seem to me that they're moving in the right direction. I'm taking from you the idea that you might be agreeing with that.
I'd agree very much with what you've said there, Jonathan, and I do feel that this trust is on its way to regaining its reputation. And I think actually for many investors it does make good sense as a core holding. And I understand what you've said there about private equity having been a drag. But let's think about Baillie Gifford, who were criticised, very considerably, weren't they, for all of their private holdings that were such a drag for maybe 3 or 4 years, quite a long time. And now, of course, it's been making hay with those and been doing really, really well from those as those valuations have caught up with what's been happening in public markets. So my sense is that the same is happening already with RIT Capital Partners, that actually private assets have been performing very well of late. And I think those are going to be possibly a tailwind rather than a headwind. But that is part of the mix, and that forms part of the risk profile here that you've got to be happy with if you choose to invest.
I think it's also worth mentioning, just in passing, we talked about this last week on the podcast with Max King, what's happening at HarbourVest Private Equity, for example, where they've just had a continuation vote this week, which they passed comfortably. But they have been very active over the last 18 months or so in introducing a whole series of initiatives quite similar in a way to what RIT is doing. And they've been rewarded with a narrower discount. And I think that message is perhaps finally permeating across the private equity sector, that if you do take these steps to try and narrow the discount, RIT have also bought back about 10% of their shares, I think, over the last 3 years. It does have an impact, whether that's just in terms of narrowing the gap between supply and demand or in terms of improving sentiment, the demonstrating that the board actually is on your side and is making efforts to resolve the discount issue. So I think that's an encouraging trend. If you look at what's happened to HarbourVest, you look at what's happened to RIT Capital. There are 1 or 2 other private equity trusts out there which haven't done so much, and they're also struggling to get their discount in. The message, I would like to think anyway, is coming across pretty clearly. I hope that's true anyway. Okay, so that brings us to the end. Thank you, Andrew, as always, for your helpful comments and insights. We'll look forward to talking to you again in about a month's time. August, always an interesting time for the investment trust sector. The markets are quiet, but a lot of trusts bring out their results over the next few weeks, so there'll always be no shortage of things to talk about. So that's it for now. Thank you all for listening.
Thank you for listening to the Moneymakers Investment Trust podcast, sponsored by JP Morgan Asset Management and independently produced and edited by Moneymakers. If you like what you have heard, do tell your friends and colleagues, and remember to subscribe through your favourite podcast app or at the website so you never miss an episode. And follow us on our social media channels. For more news, commentary and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription. All details are at the website money-makers.co. Podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice.